Two undervalued stocks to consider for November of 2023. This is a video that I've been doing since February, pretty much every single month, deep analyzing two stocks that I believe have a lot of upside potential, over the next 3 to 5 years, pretty much. Some of them go up a little bit quicker, some of them go down a little bit. I did that pretty much in October. I talked about two stocks, but I have two very interesting stocks I'm gonna talk about here in the video. One of them is a high quality company, massive margins, very rapid revenue growth, trading at a discount. I only talked about it once, and I believe it's more undervalued than ever. The second one, I also talked about it once, but this is a $300 million market cap company in a very hated industry that I believe has over a double over the next 2 to 3 years with a pretty small company that most people never heard of. I talked about it before. Most of you bought the company. We made over 30% on it because it was about to get acquired, and now the deal fell through and the stock is down like 35 or 40%. So it would be interesting to determine if this is maybe another buying opportunity again after we made over 30%. So I think you guys are really going to enjoy this. If you do enjoy it, please press the like button and maybe consider subscribing if you're new to the channel. The first stock that I have for you today that I talked about once, and it's been going down ever since, and this is a stock called Evolution Gaming, ticker symbol EVVTY for the OTC. They also have the EVO ticker, which is more in Sweden. This is a Swedish company, now sitting at $86 per share. I mean, the same level it was sitting at in 2020, yet EPS is up like 140%, and the stock is still flat because it faced a massive multiple contraction. But one of the reasons why Evolution has been coming down, because a lot of the other stocks in Europe have been coming down a lot, especially in Sweden. If you look at the Stockholm 30, the Stockholm Exchange, it's down 10%, while the S&P was down 1%. A lot of the foreign stocks have been falling. This is where I've been finding a lot of opportunities in Canada, in Sweden, in the UK, even some places in Australia. I'm looking at a lot of opportunities over there. This is what I talk about when I say you have to look outside the Magnificent Seven. I mean, there's crazy amounts of deals available. All you have to do is look, pretty much. One of those deals is Evolution Gaming. Most of you may be familiar with the business model, but if you're not, Evolution Gaming creates the games that you play at an online casino. Maybe the slot machines, maybe the roulette game. If you ever play an online casino, especially if you're in Europe, because they are pretty popular in Europe, they do make the game. And they have the game, the gaming operator, it could be MGM, it could be Las Vegas Sands, it could be Caesars. They do operate the game. So if you ever played those games, they are likely made by Evolution Gaming. Evolution Gaming has over a 40% market share. Now, the way Evolution Gaming makes money, they make money from whoever gambles, they charge them revenues, and then the gaming operator, they pay Evolution Gaming in terms of variable commissions and fees. Some of the fees are fixed, sometimes they get a commission on every single transaction, but this is the business model of Evolution Gaming. Pretty amazing. If you look at the revenues, I did say it's over a 40% market share in the regulated markets. They have maintained it. Most of their revenues come from Europe and Asia, over 175, 172 million. North America is still growing. Now it's been declining over the past months, but this is still a not mature market. It's still growing. Most of the gambling in North America is not online. Most of it is in person. And if you look at something from Goldman Sachs, they wrote about this opportunity. They said that if whenever North America starts legalizing more and more casinos, which is only 12 to 15% penetration versus 30 to 40% penetration in other markets, revenue could broadly triple from current levels for something like Evolution Gaming, which is pretty amazing. So it's still growing for them. And this is one of the reasons why the stock has been pretty much coming down, is revenue has not been growing as fast as it used to be. I mean, if you look at the revenue, was 452 million. Now, between April and June, it was 441 million. Before that was 429 million. The company is still growing around 20% year on year. But month over month, or quarter over quarter, I should say, it's not growing as fast as it used to grow. It used to grow much, much faster before. And the market is freaking out about that. Now, one of the reasons why the market is freaking out about this whole thing, and one of the reasons why it's even happening, is mainly because of the currency headwinds. If you remember in 2022, last year, a lot of companies were claiming they are facing currency losses because the dollar was going up and the euro was coming down. Well, now they are facing currency gains. This is the opposite is happening for European companies and companies in UK and in Europe in general, because now the euro has strengthened against the dollar. So what has happened to a lot of those companies, they are facing currency losses. And this is what Evolution Gaming is facing. They say in the third quarter, we estimate 6 to 8% negative headwinds on revenue growth, 6 to 8%. This is massive just from currency effects alone. But this is not just a currency effect story. There is some competition within the industry. Evolution still has over a 40% market share, but things are slowing down in general, especially in Europe, in Germany. A lot of those countries are entering recession territory, and people do gamble in recessions, but things are slowing down. I think this is pretty normal for the company. This is pretty common. And if you look at the multiple in general to see how much are we paying for this business, we're paying around 17 times trailing earnings. Forward earnings are around 15 times. This is much, much lower than what it used to trade at whenever it was growing, crazy revenues. It used to grow something like 90%, 53%, 30%. And the market is trying to compare the 25% revenues to 90%. But the multiple got way contracted, in my opinion, to justify the slower revenue growth. The forward PE ratio is something like 15 times earnings. For a company that has over a 40% market share, you look at their net income margins, over 59% net income margins. They have no expenses other than the personnel expense, because they do hire a lot of people, a lot of engineers, a lot of cybersecurity experts to keep the game safe, run the games, create new games. This is how they make a lot of money. But over a 59% net income margin, it's expected to drop to 54%. This is pretty much the same net income margin as Visa and MasterCard. It's higher than MasterCard. This is the kind of quality this company has. And if MasterCard is trading at 35 times earnings, and Evolution Gaming is trading at 15 times forward earnings. This is what I'm saying with Evolution Gaming. If you look at it in terms of a free cash flow yield kind of valuation, it's trading at a 6% free cash flow yield. I mean, this is absolutely insane, the highest it has ever traded. Now, the company is priced like it's never going to grow. So if it stays the same, they pay a 50% dividend, you're going to get a 3% dividend, and the rest is 3% in terms of a free cash flow. So over a 6% free cash flow yield for a company that used to grow 90%, and it's now growing 24%, and it's likely going to grow 15 to 20% in the future. This is outside of maybe the United States legalizing more states in terms of gambling or other countries opening up, that Evolution revenue growth could re-accelerate in the future. So I'm getting all of that stuff, very high margins at 15 times earnings, at a 6% free cash flow yield. I think the worst is priced in for Evolution Gaming, like it's never gonna grow again. Most companies, like Ulta Beauty, is priced at a 6% free cash flow yield with like 10% net margins, growing 5% revenues. This is a company growing 20% revenues with 54% net income margins, with an asset-light business model and some kind of a moat around it, around the games they have, because they have a lot of personnel, over a 40% market share at a 6% free cash flow yield. I think the company is extremely undervalued, especially for the balance sheet that they have. If you look at pretty much their cash and cash equivalent, the total is something like 813 million. Their entire debt is something like 513 million for current liabilities, non-current 412. So they're pretty much the cash position. They're going to cover the entire debt as they have no long-term debt. Amazing operating free cash flow, over 80% cash conversion. I mean, this is an amazing business model. I love Evolution Gaming. I think it's extremely undervalued, but this chart is weak. The stock might go a little bit lower. I think it's massively overdone, a massive overreaction by the market. Buying a high-quality Swedish company like this at a 6% free cash flow yield, I mean, this is like it's never going to grow again. Now, if it surprises to the upside, it just grows 15 to 20%. This is still pretty amazing. This is above the 10-year at 6% growing with amazing margins. So I like the company. I think it's extremely undervalued. So I really like it. And I just think it's amazing in general, but I don't know where it's going in the short term. So this was the first stock I have. The second one, which is extremely cheap, it has massive upside. It's also much, much riskier. It's more of a cigar butt, $300 million company that I talked about before. We made over 30% on it. A lot of you participated. Maybe some of you are new to the channel. But this is a company called CSV, which is Carriage Services. I originally bought the stock around $28 or $29. And then it fell 24% on earnings. and I more than tripled my position. And then I held it all the way from pretty much from December 2022 to recently around June, July of 2023. Then they got offered an acquisition for them to be bought of around $34 per share or 35. So the stock rallied over 30% in 2 days pretty much. I exited my entire position at $34 per share, and now the stock is trading back at $21 per share after the acquisition fell through. I love when such things happen, when such overreactions happen, because it's not really clear why the company pulled out. It's called Park Lawn. Now the company does have a lot of debt, maybe that's one of the reasons, but they pulled out of the acquisition. The stock is trading at $21. I'm going to analyze it here in the video. I think it's extremely undervalued. For those of you that don't know, carriage services is more in the funeral home kind of industry, death care, cremation, funeral services, whatever you want to call it. I know a lot of you might not invest in such things, but this is just the cycle of life. People pass away, and it's a funeral company. It's pretty simple, and they have presence pretty much all across the United States. It's only again 300 billion. 70% is funeral homes, 30% is cemetery for this company. Now the key is with the whole death care industry, it's over a $23 billion industry, but over 70% of the industry is still controlled by mom and pop kind of businesses. Now what's happening is a lot of the people that used to run the business, that they founded the business, are unfortunately passing away. A lot of their kids are deciding to sell the business because they don't want to run it, and this is why it presents an amazing acquisition opportunity for something like CSV. This is why CSV has been doing a lot of acquisition. It's only 2% market share in this death care industry that's pretty recession-proof, pretty resilient, pretty recurring revenue. This is going to happen pretty much every single year, kind of like a subscription-based business model, if you want to call it, but it's still a 2% market share. They are finding more and more acquisitions because a lot of the people that used to run them are deciding to sell them in terms of their kids and stuff. So they're getting pretty good deals on those acquisitions, but they did do a lot of them. The debt has increased, and the company is in a little bit of trouble. So they put up a plan, and they have been executing on this plan so far, and it's mainly to generate 50 to $60 million of free cash flow every single year and use all the free cash flow after they pay their $7 million dividend to pretty much pay down the debt as fast as possible. And I'm going to talk about that a little bit more. But from the earnings report, it was not bad at all. But what I mainly cared about was them reaffirming the 2023 outlook between 50 to $60 million of free cash flow. Now, if you look at the balance sheet in general, they have a lot of debt. This is a $300 million company with over $1 billion worth of debt. Now, this is bad. Most of you will say this is not good, this is not responsible. And I do somewhat agree. But this is companies that should be operating with a lot of debt because services, debt services, people pass away every single year. This is mostly recurring revenue stuff, kind of like Verizon and AT&T. So the company should be operating with a lot of debt, but I think they went a little bit overboard. This is because they got amazing deals on acquisitions. They would have only dreamed of pretty much acquiring them. They got them all pretty much at the same time, so they borrowed a lot of money to do them. Now they mainly have, this is the two you should focus on, is the credit facility, which is over $200 million, the senior notes pretty close to $400 million. Now, in terms of the debt structure, the credit facility is variable. This is what's killing them. In terms of the interest, it's between 7.3% to over 10% in terms of interest. This is a lot of interest. So pretty much you can look at the interest expense. It was $2 million in 2022. It jumped to $8.4 million now in 2023. So they're paying a lot of interest on this debt, and it's maturing in 2026. So it's coming up pretty soon. But if they use all the free cash flow after dividends, they can pay it out after 2026. I did the numbers, and I believe they can do it. You can go do it yourself. Look at it. It's pretty simple. They can pay it off. Now, the second thing you should be focused on are the senior notes. The senior notes, they are 4.25%, and they mature in 2029. So this is far in the future, locked in at 4.2%. I'm not worried about those at this same exact second. What I'm worried about is the credit facility because it has over 10% interest. It's maturing in 2026, and they have been working on paying it off. Now, because they have so much debt for the company, the market started to freak out, and the multiple faced a massive, pretty much contraction. It used to trade at a mean of around 10 times free cash flow. Now, the lowest the company has ever traded at since 2010 is around 5.5 times free cash flow. Well, now the company is trading at 5.8 times free cash flow. So it's one of the lowest, pretty much a historical bottom on the company. And this is where it traded in 2020. This is where it traded in 2011 after they also leveraged on a lot of things. So it's trading at a historical low multiple. And the way I look at it and I look at their plan is to get back to a lower leverage ratio than what they had pretty much before by 2024. And I think it's going to take them a little bit longer, maybe closer to 2025. The company says they're not going to do any acquisitions before they pay down all the credit facility, that's the $200 billion. And with them making over $60 million of free cash flow every single year, they can easily pay off the $200 million by 2026. And once they pay off some of the debt, and once the leverage ratio gets back to where it used to trade at, even below where it used to trade at before, I personally believe that once the debt situation goes away, the kind of variable debt, once you have only the fixed debt by 2025, I personally believe the multiple is going to go from 5 times free cash flow closer to 10 times free cash flow, closer to the historical average. This is what I personally believe. Now, in this case, it's a pretty simple calculation that if the company is making $60 million of free cash flow in 2025, and they do pay some of the debt by 2025, and the multiple goes from 5 times free cash flow to 10 times free cash flow, this company will go from a $300 million market cap to a $600 million market cap, which is over a 2x over the next 2 years with this company. And I believe the return could be a little bit higher because once they pay down the $200 million, they're going to save a lot on interest expense. Over $20 million in interest expense alone is coming from the income statement, just from the credit facility. It's absolutely crazy. But if they save some of the debts, the free cash flow could be a little bit higher, which means the return could be more than a double over the next 2 years. And if it takes them 5 years to pay it off, then I'm getting a double over the next 5 years, over a 15% CAGR. And I personally believe it's going to be much higher with a pretty resilient industry like CSV. Now, this is pretty amazing. This is why I believe the company is undervalued. But I have to say, this is a very, very risky investment because they do have over $1 billion worth of debt. This is only a $300 million company, so a lot of things can go wrong, but the free cash flow is pretty resilient because of the nature of the business. But you have to be careful. This is a very volatile stock. When I first bought it at something like $28, $29, it still went down 23% on me before I made over 30% after tripling my position. So if you're somewhat sensible to volatility, I don't believe this is a company that's for you because it's very small. It has a lot of uncertainties. The chart is pretty much broken, but I believe it has massive upside potential over the next even 5 years. I would not be surprised if they pay off the debts, they do more acquisitions, and they reach $100 million in free cash flow by something like 2027 or 2028. Now, based on a 10-time multiple, this is over $1 billion company, and now it's sitting at $300 million. Well, maybe they get acquired again. Maybe another company like CSI tries to offer to acquire CSV, and then the stock goes up again out of nowhere in a few months or two. You never know how such things play out, but by itself, the company is extremely undervalued. It's very risky, so I try to put the disclaimer. Maybe it was a little bit confusing. I'm not good at kind of explaining complex companies on YouTube and small caps. I'm not really good at that stuff, so if you have any questions, you could put it down in the comment below and I can answer all your questions. I don't mind. So if it was not financial advice, of course, thank you for watching the video. I really hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.